Good morning, everyone. Thank you for joining us for today's webinar. This is Amy Broadbent. I'm with JRG Advisors, and I have with me Dan McNeil from the Beasley Group. And before we get started, I just want to welcome all of our valued clients and partners who are joining us today. Thank you for spending some of your morning with us. And just a few housekeeping items before we get started. Within a few days, we will be emailing everybody today's webinar replay and a copy of the Q&A session from the end. And if you have any questions during the presentation, please type them in the question box on your screen, and we will answer them at the end of the webinar. So for the sake of time, I do want to go ahead and get started and talking about a way to try to offset ever-rising healthcare costs with a concept that is not exactly new, but it is certainly gaining popularity as a solution to offset out-of-pocket costs and help employees in terms of deductibles, co-payments, and their premium contributions. So we're very pleased to have Dan McNeil, who is a true expert in this field, with us today. And he's going to go into things in a lot more detail.
Great, thanks, Amy. Well, welcome everybody. Today we hope to be able to give you some information to consider for your group and just understand that it is a new road. It's a changing health insurance marketplace, and anytime that happens, it brings out innovative product solutions. So this product has been around for about 10 or 11 years. The reality is that most groups did not need this type of product that long ago. And so as the marketplace has changed and deductibles, co-insurance, and co-pays have increased, there is more and more a need for this. So today we're going to introduce a gap medical. You may have also heard of it as supplemental medical. But the difference is that JRG has taken an approach with this product where it is true secondary medical insurance. So don't think of this as any kind of supplemental product where someone is going to make money. These products that we're going to describe today are really designed to pay right off of the explanation of benefits from your major medical carrier to help pay for deductibles, co-insurance, and co-pays that are eligible expenses for the employees and their families. So there are only two reasons for you to consider this option. One is if we can help you as an employer group save some money in your overall spend for healthcare costs. And the second is if we can provide better first dollar benefits for the employees. So we're going to give you an overview. We're going to talk about why it's needed, some stats and facts, and then give you a couple of case examples of exactly how it works. The good news is that it is a benefit to both you and to your employees. One of the things that JRG will do with you is when we do a cost analysis for you is we will let you know if it is not a solution for your group and why. So it's very important to know that this is one of those products you don't have to take a guess on. We simply do the analytics with JRG, and we provide you with our expertise as to whether or not it is a fit for your group. So on the marketplace changes, as the Affordable Care Act came out and groups started to migrate to high deductible plans, you're also starting to see an introduction of high co-insurance plans. So it is not uncommon to see an 80-20, a 90-10, a 70-30 co-insurance plan. It's important to note that this product, if it fits for your group, does not discriminate between deductible or co-insurance. So sometimes you don't have to go to a high deductible plan, but maybe you go to a little bit higher deductible plan and change the co-insurance or add co-insurance for the very first time. The employer needs are met because we only will offer this solution if it reduces your health care cost. It is very simple, very flexible, and very affordable. You will get a 4-tier rate for the product blended in with your medical all the way down to 10 employees. These solutions are very timely. So right now, with healthcare reform, the consumer-driven health plans are being introduced. You see wellness coaching and incentives. You see health savings accounts with hospital indemnity plans. We are now adding another bullet point, another arrow in the quiver for you, and that is a gap medical plan. It is important to note that the gap medical plan can be sold alongside of an HSA, but not underneath it. So what I mean by that is if you have an HSA, you cannot use gap insurance because it would provide first dollar outpatient benefits, and you lose your tax viability of that product. So what many of our groups do is offer a dual option if they want to have an HSA, and you can put a hospital indemnity plan properly structured underneath of an HSA. So on the gap medical, it is very simple. We have here that it reimburses eligible out-of-pocket expenses for inpatient and outpatient services. Understand, when we say reimburse, we mean pay. We pay directly to the provider. So we're going to walk through a couple of claims a little bit later on the slides, but you'll see that this is a very simple process. It is a fully insured product that protects when gaps are needed. It is first dollar benefits. I often joke with the brokers and consultants and groups that I work with and say, you on the phone in the HR role and us in the advisory role, for 10 years we've been delivering bad news to our employees. Your deductibles are going up, you can't see that doctor, your rates are changing. When gap insurance works for your group, you will see an aha moment. It is not uncommon to see employees giving each other high fives as they walk away from an insurance meeting. It's been a very long time since we've seen that in our industry, but that's really how the employees see this as a tremendous enhancement to their benefits package. It is very simple to enroll. There are no applications. It's simply an Excel spreadsheet and your case is enrolled. The claims process we're going to go through, but it is also very simple. We get the EOB, we pay the money directly to the provider and kick out our own EOB to the employees. It is guarantee issue with no pre-existing condition, and obviously if we're paying off of an explanation of benefits, we do need an underlying major medical plan. You will see that the plan designs are very flexible. When you work with JRG and they share with us who your carrier is, we look at what options are available from that carrier and make sure that we plug and play the right combination of products for you. It is very flexible benefit options, so we can custom design it for your group. And our goal when we put in a group is to have a 2 to 3 year strategy so that you're not trying to do damage control each year. We have an idea in year 1 where we're headed by year 3. This product can be employer funded, employer paid. Employers tend to fund it because the savings comes from reconfiguring your plan design. And it is closely tied to the major medical plan. So what is it? It guards against financial risk associated with paying out-of-pocket medical expenses. We have many groups that we find that have $500 or $1,000 deductibles, and the employees are still sometimes dying on the vine because they're living paycheck to paycheck. So this helps with first dollar benefits. It helps to fill coverage gaps, protect their income and assets. As I mentioned, we pay directly to providers for the medical expenses that are eligible. It works in conjunction with a high deductible or high out-of-pocket expense plan. It does require major medical coverage, and it is obviously not intended to replace health insurance. So why we have this product is that 30% of employers say that a high deductible plan would be the only option that they're offering their employees in 2015. That is more than double the rate in 2014. Now, a third of employees say that voluntary benefits are a reason that they stay with or join an employer. When we put this solution in, while we're not trying to replace voluntary supplemental products, this gap insurance does eliminate a lot of the decision-making and need for the employees, and it provides an overall comprehensive package that they can really be encouraged by And the voluntary benefits then can help to do other things like replace income and help with other out-of-pocket expenses not associated with medical bills. The other reason we have this product is to minimize financial risk. Bankruptcy resulting from unpaid medical bills affects 2 million people, and it's the #1 cause of filing. Even outside of bankruptcy, 56 million adults still struggle with the health care. And many of these people had major medical coverage. So it is the $3,000 to $6,000 of assets being liquid and available to help with those out-of-pocket costs up front that this helps with. So how does this work? Well, if we start in the red square there, rectangle there, Gap Medical Plan is offered to the employees. You can do this on or off of open enrollment. You can do it mid-year. It can be either employer paid or voluntary. The employee enrolls in the plan, which again is typically done just in a group meeting, and they receive their ID card. When an employee seeks inpatient or outpatient services from the provider, they present both the major medical carrier card and our Beasley card. The provider sends an itemized bill to both insurance companies. Beasley sits on their bill and waits for the employee to send their EOB. That is the responsibility of the employee. And keep in mind, this is only for eligible expenses. So in the typical healthcare year, if I'm an employee and I go to my doctor and I pay my copay, and I go to my pharmacy and I get my prescription and pay my copay, and 6 months later I go back and get my zero out-of-pocket annual physical, I had no need for gap insurance. I always tell employees, if you're sitting in a waiting room and it is not your doctor and not your pharmacy, and you're thinking to yourself, this is going to be expensive, that is a key indication that you're about to experience a Beasley claim. What is exciting about this is when that employee gets that EOB, all they have to do is fax or snail mail that to us. They do not need a claim form. They do not need itemized bills. And they don't need a cover page. They simply send that EOB. From that EOB, we match that up to the electronic bill. We send the check directly to the provider, and then we provide the employee with their EOB from us showing that the claim has been paid. All employees will have an online portal access where they can see their claims activity. But if we were to take a $3,000 deductible case as an example, and someone goes in the hospital and they have $3,000 of gap coverage, they, between Beasley and their major medical, would have a zero deductible 100% plan. What's interesting, though, is we don't have a high number of claims per person. And the reason is you can't live in that corridor forever. You can't have 15 claims and still be under $3,000. Once someone hits their maximum out-of-pocket or their deductible, whatever amount you're covering, they're off to the other insurance company. And so we find that we typically have less than 2 claims per year for the employees, and they're either one and done. So they either got better or they hit their maximum out-of-pocket. So let's show you an example. This was about a 100 life case that we did that had a $3,000 deductible 100% plan. You see what their current rates there. And what I don't have on here is they were receiving a 20% rate increase. And that is what precipitated the phone call and asked us to look. So we went to the exact same carrier they were already with, so no changes in their prescription program, no changes in their copays, and no changes in their network. And we asked them for a new plan design, and that was a $5,000 deductible 100% plan. And you see those rates. So we had a monthly savings of $16,750, and we put in the gap insurance. So we put in $5,000 of inpatient and $2,500 of outpatient. So for those who were admitted in the hospital, they had a zero deductible 100% plan. For those who were outpatient, Beasley would pay the first $2,500. The employee would pay the second $2,500. So we still want the employees to have skin in the game. Our product does not drive utilization. There are limitations and exclusions that we can go over with you with JRG, but the key is that if it's something like a CAT scan, MRI, X-ray, surgery, emergency room, chemo, radiation, hospital, the biggies, we want to be there for the employees, and that's where this coverage kicks in. So the monthly savings for this group was still, even after paying for the gap insurance, was almost $5,000 a month and over $58,000 for the year. Now let's go through two quick claims. Let's say that someone has a delivery of a healthy baby. So Julie has a baby and stays in the hospital for 3 days. Baby Jesse's ready to go home after the first day, so he is moved to routine nursery care. So if the inpatient benefit was $5,000, and on this one we did an outpatient benefit of $3,000, mom's major medical bill would be $4,200 and applied to the deductible. The baby's bill would be $1,800 and applied to the deductible. So today the patient's out-of-pocket cost without gap would be $6,000. With our plan, they would have that same $6,000 expense, except Beasley would pay the entire $4,200 for mom and the $1,800 for Jesse. So the patient's out-of-pocket costs with this plan would be zero. Let's do an outpatient knee injury. Jack has several outpatient visits for diagnostic treatment of a knee injury while playing basketball. So he went to the emergency room and had a $250 copay. He went to a specialist and had a $50 copay, and the amount billed for the surgery was $3,800. So there was $4,100 out of pocket. On our plan, we would have paid the $250 copay at the emergency room. We do not pay for doctor visit copays, but we would have picked up $2,750. And the reason we pick up $2,750 is the outpatient bucket of money is $3,000, and so that would have left the employee with $1,100 versus $4,100. So what is covered? Inpatient is really simple. It covers everything except for drug and alcohol abuse. Now, you're still covered for drug and alcohol abuse on your major medical. It just simply says that's the only thing that Beasley is not paying the upfront cost. So 100% of everything else in the hospital is covered. Outpatients, what we cover is CAT scans, MRIs, X-rays and surgeries, chemo, and radiation. The benefit levels can be anywhere from $250 to $3,500 inpatient, and we can go up to $7,000 inpatient. Per family, we match to whatever your underlying major medical is. So if your carrier is 2 times per family, we do 2, and if it's 3 times, we do 3. Now, what is not covered on the outpatient hospital benefit will show you that this is where the advantage of dealing with JRG advisors is that we go through and we systematically look at every exclusion that Beasley has, and we match it up to your major medical carrier. So for example, if you look on here, the physician office visit for routine care, there's no reason for Beasley to have to pay for that because all major medical covers that for a copay or for the annual physical at no out-of-pocket cost. Lab work, we just matched this up with a group where the underlying major medical carrier included lab work for a $30 copay. Chiropractic services can be done through a copay, and so on and so forth. So as you can see, just because Beasley does not pay for it does not mean that the employee does. That's where matching the plan up with your advisor is the best thing to do. Okay? So the benefits for the employees or employer is this is an opportunity to broaden the benefits for once without increasing your costs. It is a gap protection solution that directly addresses employee out-of-pocket costs. For the employees, it is valuable protection against life's uncertainties. It offsets expenses and fills gaps when it's needed most. It is a very simple and easy to understand product. We do customized enrollment pieces for your group and attend the meetings and present this to your employees for you. And the claims process could not be any simpler. So today we have covered a lot of information, and we want to make sure that we answer any questions that you have. So the way that we can do that is, one, is if you send in questions now and type them in, we can respond to them. Otherwise, you can follow up with your JRG advisor, and we can set up a time to discuss the specifics for your case. So one of the questions that people have on this product is very common is the product COBRA eligible? And it is COBRA eligible. When someone leaves, if they COBRA the medical, they could COBRA the gap. They could COBRA the medical only. So if they were already over their deductible, there would be no reason to pay for the gap. What they cannot do is COBRA gap only. That is not an option because we need the underlying major medical plan in place. Okay, we don't have any further questions. So with this, I'm sorry, we do have one coming in.
Yes. The first question, is this a product available to employers only, or can an individual purchase gap medical as well?
Great question. Today, I am not aware of any carrier that is offering this on an individual basis. So we do certainly keep our eyes and ears open. I would follow up with JRG and continuously ask that question because I do believe it will only be a short period of time that there will be a product like that available, but it is not today.
We do have another question. The question is, we only have 4 employees who are eligible for health insurance. Would this be something for us?
Beasley's product was only designed and filed with the state of Pennsylvania to cover down to 10 employees, but JRG does have other carriers that are available down to 2 eligible lives. So yes, follow up with your advisor and we would be able to help out.
The next question, does gap insurance work with both high deductible plans as well as PPO plans?
The answer is yes. On the PPO plans, it works best simply because you have the co-pays for doctor visits and for prescriptions, and those are things not covered with gap. So when you go to a true high deductible health plan, and again, now it depends on if it's qualified or not qualified. So if it's a non-qualified high deductible health plan, that means doctor visits and prescriptions are applied to deductible and co-insurance. And unless you have some kind of a HRA or stop loss in there for that, it could be something that may not make the most sense for the employees. And again, if it's a qualified HDHP, so an HSA, there are hospital indemnity versions that cover inpatient benefits only and then offer outpatient benefits that are accepted benefits under an HSA, such as accident and critical illness.
Okay, there are no more questions. We want to thank everybody for joining us today. Our next WebEd event is on December 15th at 10 a.m. regarding compliance. Check your list, then check it twice. Thank you for attending and have a great day.
Thanks, everyone.